This is how you avoid the resweeps, which is considered to be the ICT's, Romeo's, lower time frame price action at the higher time key level, or the ICT tree drive pattern, which are relatively the same thing, just a little bit different. This is how you avoid the resweeps. So you wait for a sweep, market sweeps it out, you enter the trade, you get stopped out, market does a resweep of your liquidity, pause, 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 and eventually goes down lower. This is how you avoid it, and you get straight into it. Real quick before we start off, make sure you guys like, comment, subscribe, share. Make sure you guys join the Discord down below, and let's get straight into the video. As you can see, why did the market do a tree drive pattern, made a high, higher high, another higher high, then proceed to go down lower? Why did the market do a ICT tree drive pattern, or why did the market do a resweep? Is by looking at the highs that you marked out. In this case, I trade CRT, which is ranges, and each range must have enough resting liquidity for the market to go to the opposite direction. So let me give you guys a quick graphical representation. So let's say we are in a range. Right, overall in a range here. So let's say we're in this range. For the market to soup out this low, or let's say go higher, right? For the market to go lower from here after purging out the range high, it needs to have enough resting liquidity in order for the market to go down lower. If it does not have enough resting liquidity, what the market will do is make another high, purge out that high again. Now, over here, when it purge out this high, now this high has enough resting liquidity for the market to proceed to go lower, because market needs enough liquidity, enough money to go lower. It needs enough false participant to go to the opposite direction. Once those false participants get souped out, then the market proceeds to go lower. Or you could say the earlier sellers or early buyers. And now, since there's enough liquidity resting there, out of here, then market proceeds to go lower. But if there's already enough resting liquidity, what the market will do is make a range. Let's just say market makes a range here. Market will purge out the range high. Since there's already enough resting liquidity here, market will just go lower without doing a ICT tree drive pattern. In this case, market did an ICT tree drive pattern. This high did not have enough resting liquidity. What this one did, the market went lower, not because of the equal high. This could be like this. Now market had enough resting liquidity here for the market to go lower. You can see how much the market did to go lower, simply right over here. Now let's get to this chart. This is a quick graphical representation to what I mean. Now let me show you guys in a chart where this is the proof comes, this evidence, right? Right over here, you can see high. So since we're CRT traders, we're just trading ranges. That's all we're trading, right? We're trading the ICT ranges. Since we have a range high right over here, our range low is down here. We don't care about this range low. We care about this because we're trading a bigger range. Our range high gets purged. It goes lower, goes up high. But wondering, well, how come that this not have enough resting liquidity? There's equal highs here. How come it did not have enough resting liquidity for the market to go lower? The reason it did not have enough resting liquidity for the market to go lower, to proceed to go lower, is because this, although there was a bullish bearish candle on its equal highs, what does an equal high do? What I mean by equal high is by the tick. That right there is an equal high, right? When they're to the thick of the number, those are equal highs, not ones that are, like this. Those are not equal highs. They could be SMT or anything like that. So they're not equal highs or equal lows. Equal high, equal low are the same number, same digit. Those are the equal high / equal low. What a equal high, equal low does is it takes out a portion of the liquidity that's resting here. So at first, this liquidity was enough for the market to go lower, but since the market didn't sweep it, then it go above it or below it, it just stayed the same line. It took out a portion of the sellers. So some people had their stop loss right over here. It took a portion out of it, then the market eventually went lower. So it took a portion out of it. Now there's not enough liquidity for the market to go lower from here. So the market needs to go back up higher, which it does, and purchase it out by this liquidity. Now, even with this, there's not enough resting liquidity. As I said, it took out a portion of the liquidity here, so there's not enough resting liquidity there. Now, with this high has enough resting liquidity. Since this one over here, let's just say their bullish bearish candle doesn't matter. At the CRT high, CRT low, this must be only to avoid the resweeps. There must be only a bullish bearish candle for a bear sell side liquidity. For a buy side liquidity at the CRT high, it must be a bullish bearish candle for a buy side liquidity. If it's not that, it's just a right hand bullish candle or a swing high or a swing low or equal high, equal low. What you're looking to do is letting those highs get purged and looking for a retrace back down and looking for a valid high to get formed, which is a bullish bearish candle. And eventually looking for the valid high to get repurged, then go lower to your drawn liquidity. As you can see right over here. That's what you're looking for at the CRT high to avoid the resweep. But if there is chances where the market doesn't leave a valid high or valid low, and you have these equal highs or equal lows, or the swing high or swing low, just a bullish bearish candle at the CRT high or CRT low, you're looking for this high to get souped. You're looking for the high to get resouped. After the market forms a valid high, then go lower. So those equal highs here, because the equal high takes a portion of liquidity. So this is right here has liquidity. This one takes out a portion of the liquidity. Now they don't have enough liquidity there for the market to go lower. Market takes it out. Now here, market has enough liquidity for the market to go lower. So market needs to go back up all the way here. Why does the market need to go back up all the way here to go back to lower? Because in order for the market to go down, it needs to go far up first. If the market wants to go up, it needs to go first down first. So if you're shorts, you want to sell high. If you're buys, you want to buy on discount, right? Obviously, you want to buy cheap, sell high. And market needs to take out liquidity. Market cannot take out a sell side liquidity. Then think about it. Think of going lower. It can't do it because it just took sell side liquidity. So it needs to go take out buy side liquidity, then go lower. So you take out buy side liquidity, so take out the early sellers and bring new sellers to the down market to the downside. If you take out sell side liquidity and tries to go lower, it wouldn't work like that because he just took out buyers and he bought new buyers in the market. So there's no way that the market go lower from that because new buyers just get in to price to the upside. And keep in mind, when I say that the market makers are not the banks, they're not the hedge funds, they're not these bullshit people. It's not me, you. We're not the market makers. We're willing or unwilling liquidity. It's just a market pattern. I'm trying to say. The market should do. I'm saying it in that way where people can understand. Otherwise, I would have said, okay, doesn't have a valid high, so I'm looking for repurchase because it's a pattern I've constantly seen in the market where the market should do, which is the ICT 3-chart pattern. Or the way I'm trying to say it so you could understand what I'm trying to say here. Eventually, you can see market didn't leave it a valid high here because a portion of the liquidity is already taken out. Over here, now there's enough resting liquidity. So for the market to go lower, it needs to take out passive liquidity. It needs to take out passive liquidity before going lower. It needs to go up higher, then go lower. Right? If you're selling, you want to sell high. If you're buying, you want to buy low. So you want to go up higher, so they take out passive liquidity, then eventually went down lower. Now, this equal high did not have enough resting liquidity. Well, this one did. So after you formed a legit high here, market projected the legit high, then eventually went down to the downside to the drawn liquidity. Now I'm showing you guys more examples to what I mean here. And let me see if I got good examples to you guys. Let me see if I go back in the chart. Actually, they could go back all the way here. Do I gotta go down here? Actually, let me just go back in the chart and show you guys a good example, which is right over here. And since we're CRT traders, this is the 5 a.m. CRT high. 5 CRT high gets purged. 5 CRT high does not have legit high. How come? This bearish candle is from a different 4-hour candle range, so there's no legit high here during a specific range, specific time. So market pushes it out. But wondering, well, why did the market go back up here and push it out one more time? Why did the market push it out one more time here? When he's pushed out the liquidity, they did not leave a bullish candle, so there was not enough liquidity here now. How come? They didn't leave a bullish bearish candle. A bullish bearish candle doesn't take liquidity. It have enough liquidity there. It doesn't take a portion of the liquidity. So he has the whole. This one doesn't have the whole, so looking for this high to get burst. Now, once this high gets burst, now market has a legit high here, bullish bearish candle. Now there's a lot of rest of liquidity here. So the market goes back up higher, then go lower. So now when this happens, you are avoiding this spot of liquidity, avoiding this spot of liquidity. You just primarily care about this. Then market proceeds to go lower to your overall drawn liquidity, which is to the downside. As you could see. And let me show you guys another example. Right over here. So wondering, well, why did this high get repurchased here? The reason this high get repurchased, you can see this market went up high, repurchased high, and eventually went down lower. Why did it do that? Because this time, so the time people trade this, the best liquidity that happened over here wasn't the right time, so market proceeds to go lower. I think this is not the actual example, right? Is it? Nope, it's not that one. I wonder, like, this just seems off. That's a good example, but I was wondering, like, what the fuck? This right over here is the example, I mean. This Friday. Mark the 6 a.m. candle. This right over here is our project. Mark out the 6 a.m. high. You see, this candle has a legit high, which is that 1 a.m. range high. It does have enough resting liquidity here. The 5 a.m. purge it out. But why does the market purge out this liquidity again, then go lower? Why? So those who took a short here, they got stopped out. Why did they do that? Simply because of when this liquidity got purged out, it didn't get purged out at the right time. So there's not enough participants to get into the trade to push the market to the downside. So the market goes up back up higher, then goes lower. Why? How? The time is priced because, as you guys know, the most participant in the New York session is between 6 a.m. and 10:30 a.m. This purge happened at 5:45 a.m. And the 6 a.m. when it's supposed to be the most participants, now purged out the 5:45 a.m. high. So we're looking for this high to get repurged because market did not give us the right time to purge. And as you guys know, the video is all about how to not get resweeped. And what is a resweep? We're always looking for a sweep here. So market didn't, from 6 a.m. to 10:30 a.m. There are the most participants there as well. That's when we're looking for sweeps. So the sweep never happened between 6 a.m. and 10:30 a.m. So we're looking for this high to get resweep, which it does. Then eventually goes lower. Why? As I said, there was not enough participants. There's not enough liquidity here generated for the market to go lower. But now, when the right time came in, now there's a lot of resting liquidity here. When the market pushes it out, then eventually goes lower because this is now where we're implementing time into the trade. Now, if you guys, let me give you guys a little bit more example. Let me see. Let me use my insights, our smarty insights here. Well, let me go back on our time, which would be, let me see if I got a good example here. Let me see if I got a good example. They happen, but they rarely happen. Let me see. That's not a good example there. What was it? This one didn't give us the right model. You can see, in this case, why did the market go back up higher to push out this high? There's many reasons here now. Because the model 1 wasn't the right model 1, so market pushes out the liquidity once again, then we'll down lower to our drawn liquidity. So another little quick sauce to you guys, which all of 3 sauce must be implemented and they all must be correct. to get the highest probability setup. To get the highest probability of this, to get the highest probability of it working out in your favor. Because all the examples I got, I don't see any more examples. I'm pretty sure this should be it. Let me see here. Yeah, there's a legit low here. So I'm gonna go report about. Okay. Yeah, even here, a good example is there's a legit low here. Yes, there's a legit low. Market pushes it out. Cool. But why does the market reprice out this low again before going up higher? Two reasons. First, there's a range. There's a 4-hour range. 4-hour range low here. Second, there was no model 1 confirmation, so this low could be repriced multiple times. This low gets repriced, and this other low gets repriced with it. We don't care if this low gets this low because the most dominant low. When this move up to the move down, this specific time of this specific range, I mean. So specific time of the 4-hour candle. So it gets repriced. Eventually, market goes up higher from here. You can see why the market go low here because it's news. But guess what? Why does low gets repriced? You know, this low number got repurged here. Got purged, went up higher. This low number got repurged because news and everything was correct there. Market went up higher. Give you the model 1 confirmation. And eventually long that shit up. But yeah, this is how you avoid resweep. This is how you avoid the ICT 3-drive pattern. It's by simply looking at the high or low of the CT high low by looking at it and seeing, okay, does this CT high low have a legit high or legit low? By legit high or legit low, does this CT high low have a bullish bearish candle for a basket liquidity? Does it have a bearish bullish candle for a sell side liquidity? Or if it doesn't have that, you're looking for that looking for that liquidity to get purged, but a CT high to get purged, and you're looking for a repurge after it forms a valid high. Then after that valid high, you're looking for a model confirmation. It's shorting either down or slowing it up. It cannot be a swing high or swing low. It cannot be a equal high, equal low, because equal high, equal low takes a portion of the liquidity. It can, and what I mean by equal high, equal low, they must be the same type. It can't be like this. No, it must be the same type. Because other ones, they're probably SMT divergence there. So they're not equal low. And it cannot be a random bullish or bearish candle. It must be a valid high or low, which is bullish bearish candle or bearish bullish candle. Otherwise, looking for that high to get purged. And then you're looking for a valid high to get formed, which is bullish bearish candle or bearish bullish candle. Looking for the high to get purged. After that high to get purged, looking for a market confirmation. At the market confirmation, you can execute a trade. Then you could possibly still lose because it's probably to game. But this just makes your chances of the work. It just gives you a higher probability, and as well as, yeah, that's how you do it. This is how you avoid resweeps. This is how you avoid the ICT 3-drive pattern. This is how you know that lower time frame price action at the high time frame key level. Is by, you don't have to look at that lower time frame price action. All you have to look at it is that, you know, CT high, CT low, and look at that if it's a valid high or valid low. If it's not, then look for a resweep. Then look for how to get formed. Then look for that resweep as well. Then look for model 1, the right model 1. Then execute it down, log it up, make money or make money or not make money. After that, if it does not happen that you either don't take a trade, you're done for the day. You don't take a trade, you call it a day, because valid high, valid low is not there. The valid high, valid low did not get purged, so you're done for the day. This is a non-negotiable rule for me, especially. So yeah, see you guys later. Peace out. Thank you for watching. I'll see you guys later. Join our Discord down below. Peace out.